AT&T. This is a company that seems like a deep value play, but is it? That's the question. And to me, the debt situation is something that really stands out. So let's go look at AT&T and what they reported in their second quarter results. So something that I really like here. These guys are a leader in fiber networks in the United States. They added 300,000 customers, and this was the 10th straight quarter that they've added 200,000 customers with the fiber network. And they have the ability to add 18 million. So 18 million people can get fiber if they want to. Why they don't do it, I don't know. Now, let's start scrolling down here and seeing what we have going on. Remember, they did this spinoff with Warner Discovery and whatnot. So a lot of their numbers do look a little bit skewed, but I highlighted some things that excluded the divestiture. So excluding the impact of these divesting, operating revenues for standalone AT&T were up 2.2% from $29 billion a year ago in the same quarter. So that is something, this is a company that I call a dinosaur company. It doesn't move a lot. Lately, it's just been moving down on a stock chart. Income from continuing operations was $4.8 billion versus $6 billion in the quarter a year ago. Not good. Second quarter revenues from their communications was $28.7 billion, up 2% year over year. So that is promising. Now in the mobility space, total net adds, 6.6 million. That includes postpaid, prepaid, and whatnot in that mobile subscription area. Postpaid churn was about 0.93% versus 0.98% a year ago. So there's some stagnancy going on in this company, some growth, some declines. I think, before I go any further, what I think needs to happen here, and this is something that I'm waiting on, I need more data to come out from them. This spinoff is too new. So what I'm going to look at and say is, okay, give me a few more quarters. This data came out. That's great. Now let's get another quarter, maybe one more quarter, and then I can have a little bit more data, a little bit better landscape, and understand which direction this is going and what their plan forward is. Now, from the business side, revenues were down. They kind of made a strategic decision to do this, not putting a big emphasis in this space, but they were down 7.6% year over year. Okay, the company is updating its 2022 free cash flow outlook, and it is actually reducing it, and it is going to lower its full year guidance from the $16 billion range to the $14 billion range. Not totally surprising. Part of their restructuring, part of their divestitures. It's not totally surprising. Now, let's go into the 8 pillars, and something that I wanted to look at here before we got going, because I talked about the debt. So you look at the 8 pillars, kind of scary. You have a good 5-year PE ratio of 7 and 7.5 basically, and price to free cash flow that is 5.18. Now, let's go and look at the balance sheet, because I want to look at the debt situation and just show you something that worries me, but it's industry-wide. So total current assets of $34.5 billion, total current liabilities of $49 billion, and come down here, total long-term liabilities, $242 billion. Total liabilities, $291 billion. Now, let's go to Verizon. Verizon is going to be in a very similar situation when it comes to their balance sheet. You see total current assets of $37.5 billion. Total current liabilities, $49 billion. And come down here to this long-term and total liabilities number. They're astronomical, $233 and $283 billion respectively. Let's go over to T-Mobile just to make sure it's not one company. Same thing, $17.5 billion total current assets, total current liabilities of $20.6 billion, and you come down, their long-term liabilities are a little bit better, but still $118 billion, total liabilities $139 billion. So you can see that it is an industry-wide situation where you have all of this debt. Is that a good thing or a bad thing? I don't know. It's a very capital-intensive business. So I'm going to go and look at the income statement real quick. I want to see the revenue that they've been driving. So let's see here. You know, it's not consistent. It's all over the place. 127 billion, went as high as 162, 183, and now it's down to 148. So I don't love seeing that, but we have to remember that they did that big divestiture. Now let's see. Net income is kind of all over the map and kind of always has been. 7.3 billion, 18 billion. But again, and I haven't said this yet, this is a company that did a lot of acquisitions, and a lot of acquisitions that totally flopped. The biggest one is probably their DirecTV deal that they got rid of last year. But this is a company that does a lot of acquiring to grow. Now, something else that you wouldn't expect from a company like this. They've been diluting their shareholders. It's not totally worrisome, but they have absolutely been diluting shareholders. And for a company this big that pays as big a dividend as they do, and this is why a lot of people love AT&T, I would like to see them be buying back their shares and paying down their debt instead of paying out a, what is it now, an 8%, 11.1% forward dividend. I mean, to me, that's totally absurd to be doing with a debt situation as big as they have and a diluting situation that's going on. Let's go over to Stock Analyzer and run this thing. Okay, so what are we going to put in here? Revenue growth. I'm going to go pretty conservative here. I'm going to go with a -2% over the next decade. I'll put in 0 and I will put in 2 on the high side. Let's say that everything works out for them. I'll put on 2 on the high side. Profit margin. I'm going to go 8.5, 9.5, and 10.5. And I'm going to give them the benefit of the doubt. No, 10.5. 10.5 is too high. I'm going to go 8, 9, and 9.5. They haven't done it over the past decade. What would change? Free cash flow margin, I'll go a little bit higher. I will go 9.5, 10.5, and 11.5. And I suspect that our numbers are going to come out here pretty decent. Now, PE, 10, 12, and 14. Price to free cash flow, I'm going to go with the same number, 10, 12, and 14. 12 and 14. And for my return, this is not the, you know what? I'm going to go 13%. It's not the most risky investment in the world, but because it's such a company that doesn't move much, I want a little bit extra on top of that 10% that I can get from a ETF. Now, $16.89 is the current price, and here's your price sitting depending on the assumptions that you make. I'm sitting somewhere in the basically $12 to $24 range, depending on which way you go about this. So the question becomes, are they going to be able to drive growth in the future? Where is that going to come from? Can they stop diluting their shares? Can they stop going into this astronomical debt that they can't pay off? Can they stop acquiring companies that just totally flop on them and screw their shareholders? I don't know. That's the question that you need to answer. If I'm looking at this company, I'd probably come out here and look at some options, because if I do believe that the company's $12 a share, maybe I'll go out to, let's say, June of 2023 and look at some options around that $13 range. Now, I'm looking at this is an options chain. $13 a year from now, basically 12 months from now, I'm going to get 49 cents a share. It's a good way to collect a little bit of income, to sell some puts on it, and maybe I'll get assigned the price of those shares. Best case scenario, I guess, I'm a shareholder, stock price goes up, and I still get that 49 cents per share and don't get assigned those shares at $13. But that really all of this comes down to, how are they going to look going forward? And for me, I need to see more data come out of this company. Now, if you don't want to do anything that has to do with investing in AT&T, you can come over to a chart, because I think they have a lot of promise. And I'm going to pull up the long-term chart, because this is a great company that you can get a really, really great run on. So back when I was trading full-time, AT&T was one of my 5 stocks. I had 5 stocks that I traded every single day, very similar to the Employed Trader series. And AT&T was a great one, because it would have 3 moves per year. This is my weekly stochastic. So this is over a year's term. My stock price would go up, and I would go long right in here, and then it would come down, and I would go short right in here, and it would make 3 moves per year. So I can go long, short, long, short, long, short. And that was a great way to make money on this company. Now it's a little bit different, because it just keeps coming down, down, down. But right now, we're getting to this really strong support level in here. Numbers that haven't been seen for quite some time. I am going to throw a tracker share on here. It's going to cost me about $17. Worst case, this company goes under. $17 is gone, and I lose $17. Best case, this thing starts to turn, and it starts to make a big run, and it fills this gap, and it gets up here to this $21 range. I do think that as soon as AT&T starts getting some good news behind it, maybe from the fiber area, maybe from the mobile area, I think this is going to be a company that can turn it around. It's just a matter of management doing that for them. So I just looked at AT&T on the surface. If you want a much deeper dive, I'm not going to just buy on or sell based on what I just saw right here. I need to do a deeper dive. I need to get more nitty gritty, go into more analyst estimates, go into more numbers. Click this video right here. I did a deeper dive on Intel, and you can see just that. Catch you on the flippy flop.